Welcome to the Investor Summit Green Room, the behind-the-scenes monthly podcast where we bring you informal one-to-one interviews, panel discussions and presentations with leading fund managers, city professionals and financial journalists, which we hope lead you to make better investing decisions. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. Today, we welcome Jacqueline Brewer as Joint Portfolio Manager at Utilico Emerging Markets to the Green Room. UEM is an investment trust specialising in high-quality emerging market infrastructure and utilities companies. For the last decade, UEM have paid a progressive dividend with an attractive yield currently at 3.7%. UEM is in the FTSE 250 and has a market cap of just over £500 million. Welcome to the Green Room, Jacqueline. How are you?
I'm good, thank you. Thank you, Donald.
Fantastic to have you. Now, let's talk UEM. I suppose, first of all, we have to say emerging markets. Why emerging markets? Why is that the initial focus for UEM?
Yeah, we've been investing in emerging markets now for over 20 years, primarily because of what we see as the fundamental structural growth drivers, which are the backbone for emerging markets to grow. First of all, we've got positive demographics. We've still got quite young populations. If you look at India, for instance, the population's age is around 28. Vietnam is around 33. We've still got rising urbanisation rates. So at the moment, the urbanisation rate, again, if you look at India, is around 27%, and in Vietnam is slightly higher. And they're seeing that converging to sort of a more developed market stage, which is 70-80%. So you've got a lot of growth coming through there from into infrastructure and utility assets for them to shift up to more urban status. Also, we've got the rise of the middle class. As we're seeing the rise of the middle class, we're seeing rising incomes. And then there's more demand for growth in goods and services, which is also positive for emerging markets. So again, you can see good, strong growth coming through within EM. And finally, generally, on the whole, we're seeing more stronger rates of GDP growth within emerging markets. Vietnam, before the Middle East war, were predicting 10% GDP growth for the next 5 years. Quite punchy. Whether they're going to achieve that or not is debatable, but you can kind of see the level of growth that these countries are growing at, and that's providing us with good opportunities to invest in. But
GDP growth in emerging markets is considerably higher than in westernized countries.
Yes, it is at the moment. Yeah, even India, which is struggling, is still 5-6%. The Philippines is around 6-7%, and Vietnam is, like I said, punching above 10. We'll probably like to see about 7-8, but yeah, it's like higher GDP growth.
Does that translate into positive growth for stock prices? If you can start off with 6% growth already baked in?
Yeah, it does, because obviously a lot of investments that we're making into the infrastructure utility sector are obviously growing as a multiple of GDP. So for instance, as we're seeing the growth in the middle class, for instance, people want to travel more, higher percentage to consume, want to have car ownership. So something like a very simple asset like a toll road, for instance, as we're seeing higher GDP growth, we'll see higher traffic volumes, and therefore that will translate to higher revenues and better cash generation, better valuations. Should flow through.
Okay. It's worth taking a moment to ask how you and the team actually pick your stocks. What size of a portfolio do you have in the first instance? And then what's the process that goes into the stock picking?
Yeah, at the end of the day, we are looking for the top 60 to 70 infrastructure utility companies that we believe that can provide our investors with the best long-term total return. We're looking for assets that may be undervalued, mispriced, or just overlooked. So we're constantly scanning across the whole of the emerging market infrastructure utility universe. There's probably about over 1,000 companies that we can look at the moment. But we're a fundamental bottom-up stock pickers. We are active managers. We are benchmark agnostic, so it doesn't have to be in a certain country or certain region. We're looking for the best return for our investors. We look at fundamentals. We build every single company we look at. We invest out. We build out a financial model. We do financial forecasting. We analyse that. We travel quite a lot, so we do try and go and see investment companies. We try and touch the assets literally to make sure that what we're hearing or what we're reading is actually true to life, so we can really sort of kick the tires of each investment that we're making. But at the end of the day, also the management team, it has to have a strong management team, and the regulation within that country needs to be supportive of the investment return for us to be able to make that investment.
Of that 1,000 companies, how many of those would you say are actually investable? How many are you actually drilling down into when push comes to shove?
Probably we're constantly looking, and any company that was once investable can always become investable. So it depends. But yeah, there's probably a good active list of about over 500 companies, I'd say.
So that's your sort of rough watch list, you would say?
Yeah.
Okay, very interesting. And have Trump's tariffs actually changed things, or have the Trump's tariffs actually had less of an impact than you might think?
Had you asked me that question a year ago when we had Liberation Day in April, things were all over the place. Things seem to have settled down. The flip-flopping or taco policies of Trump have definitely changed and have definitely meant that investment companies, I suppose, had put on hold a year ago investment decisions. What we saw, we went to Mexico earlier this year. We met with a logistic warehousing company, and what we saw from them and what they were telling us is, yes, they had put on hold investment decisions, but now what was coming is actually this is the new norm. This sort of flip-flopping between tariffs is what they're seeing. But actually what Trump's tariff has done is actually sort of questioned US exceptionalism to some extent. And therefore, actually, we're seeing, the growth in intertrade within Asia. That's been positive. And actually, companies and countries are sort of working out or finding ways around the tariffs. And that's providing us with investment opportunities.
And finding new ways to trade. So how do you as a team actually keep on top of the fact that the world is constantly changing and evolving when 10 years ago, everything was growing and the world was trading with the world, whereas it's much more complex now?
Yeah, look, when I started this job sort of 15 years ago, it was very much looking at every stock, but now the geopolitical noise is much louder, I suppose. I think what we're doing, though, as an investment team, we're trying to stick to our bottom-up fundamentals of stock selection and ensuring that, the geopolitical noise, which are, I suppose, shaping the bottom-up process that we're going through, but we are trying to keep on top of all the noise and how it's affecting individual investment.
Okay. And which of the countries and sectors that you invest in are doing well at the moment?
Two companies that are doing very well in our portfolio. The number one company is called Horizon. It's in Brazil. It's got a market cap of about $1.5 billion US. It's a waste management company. Not very exciting, but look, what they are collecting around 9 million tons of waste per year. They've just made an acquisition to double the amount of waste they're handling. And what they're doing is they're taking the byproduct from landfill sites, the biomethane, and then being able to sell that and turn it into sort of energy and sell it on as well onto third-party providers. And their share price is up over 60% this year. Another one is ICT. It's a Philippines port-listed container terminal operator. It has around 33 terminals in 19 countries. So it's a global emerging market port operator. And these guys have been fantastic managers. They basically acquire inefficiently run ports, go in, rip out excess costs, pick up volumes, and get huge operational leverage and drive their margin expansion. And their share price is up over 100% this year, just to testament of their strong financial results they've had and operations as well. And when you compare that to, say, the Philippines index, which is down 7%, I think it's just showing you the good stock selection that we've had. Country-wise, as everyone, you might know, but our portfolio is quite LATAM focused. We've got about 45% of the portfolio exposed to LATAM at the moment, which is obviously much higher than the MSCI Emerging Market Index. And LATAM has had a very strong year this year for us, partly because of the global, partly because of global issues as well. You had the demise of US exceptionalism, investors looking for non-US assets, looking to go elsewhere. And LATAM has been a good diversification away from the US because it's also commodity driven. And also the FX has helped, again, with LATAM. And then country-wise, Brazil, again, this year has been strong for us. The first time we've had the geopolitical fallout from the US plus Brazil aligning. Because what we're seeing in Brazil at the moment, they've had very high nominal interest rates. They've just started reducing. So you've got monetary easing coming through. We've also got election coming up in October. And the expectation at the moment, things could always change. As we know, with elections we're seeing elsewhere globally. But at the moment, the expectation is there to be a swing from the left more to the right, which will bring much more business-friendly policies, hopefully. And hence, we've seen an uptick in the Brazilian market.
So you invest in ports and infrastructure. Have the problems with the Strait of Hormuz been causing issues for some of your companies? Have the energy crisis, is that affecting any of your stocks?
Our exposure to the Middle East directly is around 1.5%, and they're again based in very domestically driven assets, which the Strait of Hormuz hasn't had an impact. Where we're seeing potentially impacts, and that's what we've been discussing constantly, for instance, is something like ICT, the Philippines port-listed operator. They've got a terminal in Iraq, so they've stuck. So we're expecting reduction in earnings. But as we always say, it's cargo delayed, not cargo denied. Once that strait opens up, the volumes will flow, they receive the revenues. At the moment, they're churning or they're earning revenues on storage income. So actually, the impact is more limited. Where we're seeing the bigger impact is, yes, as you mentioned, on energy, on countries that are net import or net energy importers, such as India and the Philippines. There we're seeing, potential for higher rates of inflation. As we see higher rates of inflation come through, it means that countries have to be more aggressive with their monetary policy, and potentially we can see interest rate hikes, higher interest rates, higher cost of capital, lower valuations, and just purely market sentiment as well. So that's where the pressures are coming. But the big question at the moment is, when will it open? And we're all hoping that it will open sooner, because it will then start affecting global growth as well, which we're already seeing come down.
Utilico are focused on long-term investment themes, the fundamental drivers of growth in countries like Brazil, Philippines, India, China, Mexico. Talk me through the investment philosophy.
Yeah, so we've got the structural growth drivers for emerging markets, and then on top of that, we've got what we call these megatrends. The infrastructure megatrends, and they are, for instance, social infrastructure, which at the moment in the portfolio is around 37% of our portfolio, and that is looking at at the end of the day, emerging markets still require a lot of investment to social infrastructure, i.e. water, waste, etc. And as middle class are growing, we're seeing demand for social infrastructure assets like toll roads, airports also increasing. So that's one of the megatrends that we're focused on. The other one is energy growth and transition, investing into sort of electricity distribution companies, generational transmission companies. That is also what we're focused on.
I'm going to stop you there. If people are not familiar with emerging markets, they don't actually understand how we're used to Britain being a little bit of a shambles. But you actually look at how Mexico have dealt with this. You look at how India are dealing with this. They're actually getting genuine infrastructure projects through and developed and built.
Yes.
So why don't you talk me through a couple of case study examples? Just explain how they are actually working.
Yeah. So look, I suppose if I talk about energy growth and transition, there's been a big push to move towards renewable energy sources, but also what's happening within emerging markets, and we're seeing that on the back of the Middle East, is the requirement for energy security. That's been a big push, and now is becoming even more of a big push. India, like I said, is a net energy importer at the moment. But what the government has done there, for instance, within the hydro sector, for instance, we've invested in a company called NHPC, which is a hydro company. They have put very attractive regulatory models in place, so you can earn a return on asset investment of around 16-17% for your the capex that you spend on building that hydro plant. So what I suppose emerging markets are doing in order to improve infrastructure and utility investments is they're offering attractive regulatory models or concession contracts to encourage that investment to come in. Because as I mentioned earlier, these countries can't exist or can't develop without funding from external parties. The governments can't afford to do so.
So what's ultimately good for the government is also good for UEM.
Yes.
And it gives you long-term stability.
It does, yeah, because the concession contracts tend to be 30 to 50 years.
The current NAV it's better than it was, but it's still not quite as good as it might be. You have a new below 10% target and lots of other buybacks and things. So talk us through that.
Yeah, the discount, it's been frustrating. We still trade at around 10-11% discount. It's better than it was. It's coming from 18% this time last year. It's now 10-11% now. We are the new board. We've got a new board. We've got a new chairman that came in January 2025. We introduced some new shareholder initiatives to try and target the discount, such as increasing share buybacks, formalising, I suppose, the progressive dividend policy, even though we were increasing the dividend over the last 10 years, but sort of making it much more of a formalised structure, and also bringing in the 5-year tender to try and encourage to narrow that discount. We're also doing things like this, much more marketing to try and keep the discount coming down.
And do you think that's how it should be?
We'd love to be trading at a premium, I think, given what we're doing and the investments we're taking.
Well, it is slightly baffling, given that you are doing an awful lot of fairly unique and fairly rigorous and fairly good things. Yeah. To see you trading at a discount. Well, it's better than it was. So, who are your shareholders? Are they a mix of institutional and retail?
Yeah, we've got a mix of institutional, private wealth managers and retail. They've been relatively quite stable over the last sort of 10 to 15 years, 10 to 15 to 20 years now. And we think that's quite a good blend of shareholders.
And Saba, Now, I remember looking at you a year ago and thinking, oh, Saba's got perhaps 6%, but I couldn't find out much about it.
Yep.
And I thought I'd put some money into you and I took some money back out of you because I just thought, oh.
Thanks all.
Well, that's the nature of
Yep.
that's the nature of Saba. Are those tender offers and the buyback schemes partly there to manage that relationship?
No, Saba came on the register at the end, within in May 2025. As I mentioned, we had a new board chairman came on, Mark Bridgman, in January 2025. So in advance of Saba even coming onto the register, or us being aware of Saba on the register, we were already having active discussions with key shareholders as to how we can improve the fund and how we could narrow the discount. So those shareholder initiatives were already in process. And I think that the fact that over 97% of our shareholders voted in favour of those initiatives in September 2025 is a testament of, I suppose, how happy all the shareholders are with those initiatives, not just Saba.
Mm-hmm. You've already told us that MSCI Emerging Markets is your benchmark. But I also know, because I've followed the company for some time, that it's not a particularly good fit for UAM's unique portfolio. So talk me through the benchmark and what you might prefer as a benchmark, perhaps.
Yeah, it's difficult to put us with a benchmark. Look, at the end of the day, we had to, when we put the tender out for 5 years, we had to have it benchmarked to something, and there was a sort of a call to be MSCI EM index. But look, we look at it over 5 years, because at the end of the day, we are very diversified from the benchmark. We have an active share of over 98%, i.e. very little correlated. I mean, if you look at the top 3 stocks within the benchmark at the moment, it's TSMC, Samsung and SK Hynix, which have about 25% of the index, and we have zero exposure to those. If you look on a country basis and a sector basis as well, on a sector basis, we have about 50% exposure to utilities. In the benchmark, it's about 2%. So again, you can see how different we are. And then on a country basis, again, we've got Latin America and with Brazil exposure at 26% versus the index, which is around 5%. So it just shows you how differentiated we are. However, this year, given all the AI euphoria that we've seen and the real, I suppose, growth within the sort of the tech sector, I mean, we've actually, this year, we're basically or marginally underperformed the MSCI EM index by 0.6%. So I think that's a good testament of our stock selection and the companies at which we're picking, that we've managed to keep up without this tech exposure. So, yeah.
So why are benchmarks so important? I mean, if I'm, as a private investor, I simply earn absolute return.
Yeah.
So why should you guys be benchmarked rather than hitting absolute return?
The question was always, what would the absolute return be? So yeah, therefore it seemed to be the benchmark, because at the years when also, if you had an absolute return benchmark, you could have years of, say, the benchmark massively underperformed that year. You could massively underperform and you wouldn't hit your absolute return. So therefore it's also, the benchmark is there for, I suppose, to help you through the ups and downs of the market cycle as well.
So it's actually positive.
It is a positive. That's why we try to do it over 5 years. Over 5 years, we should outperform. And MSCI, if you look at us over 5 years of inception, we have outperformed the index. And
what sort of performance can we expect from your portfolio? Do you want to just give us a sense of it?
Yeah, look, we're always targeting sort of mid to high teen growth within our assets on an IRR basis. So that's what we're trying to achieve.
Okay.
Yeah.
And what would you hope your NAV does relative to that?
Well, we hope, the NAV grow in line or above as well. Yeah. And the discount obviously to narrow.
Whenever I get people in front of me, I like finding out about them as professionals, not just as I suppose the talking heads really. You trained as a chartered accountant, and then you worked in corporate finance at Lehman's and Nomura.
Yeah.
In what way does having such a highly numerate background actually help you with your day job?
Well, I think the sort of the chartered accountancy qualification that I got at PwC many years, just a few years ago now,
helped. A couple of years ago.
Yeah, just a couple of years exactly. Really helps me understand the financials of the company, how they all work, and then going on to Lehman, the financial modelling and really understanding, what the strategy of companies, markets are like, that sort of thing really has helped in my current job at the moment. So yeah, it's been positive. What it hasn't quit for me with is how to understand Donald Trump, which is always a challenge, I suppose.
Yes, I don't think you can go to university to understand how to understand Donald Trump. So Lehman's, big American bank, Nomura, Japanese, different cultures. What was that like?
Yeah, very different. We're at Lehman's, and I was there, obviously carrying out my box when Lehman's went under. But I was fortunate enough that the Nomura came in, obviously, and bought the European arm out of Lehman's. But the culture was very different. But at the time, when we were at Nomura, effectively it was just the Lehman team. So it was still very Americanized in many ways, but we just didn't have the brand name of Lehman.
Okay. Was there a point in your life which you regarded as your big break? Did anything ever come along where you went, my life changed from one day to the next? For me, it did work like that, but I'm not sure if it has. And you're looking baffled. Was life always just a smooth progression for you, Jacqueline?
I wouldn't say walking out of my cardboard box from Lehman's was smooth progression.
No, that wasn't clearly not the best
didn't
moment.
Didn't quite know what was going to happen. Yeah, look, I mean, obviously, I think going to finance, much more into banking, which was a good start, and then the opportunity at ICM now, where I am, is I've been there for 16 years, I think, which is testament to.
How did you make the transition into investment trusts?
I was looking to jump from the sell side to the buy side, and came across the opportunity at ICM at Utilico.
And you've been at ICM ever since?
Ever since.
Okay, here we go. What's your outlook for the remainder of 2026? My final question. How would you wrap up 2026?
I mean, look, it's been an interesting start this year already. I think the key question what will happen in the Strait of Hormuz and what the long-term impact that will be. We're starting to see that coming through on inflationary pressures, like I said, within the Philippines, within India, also in the UK. We're seeing slowly the futures oil pricing converging to the spot pricing, which is showing that actually the market is slowly recognising that oil pricing should be higher probably than where the futures price should be higher than it should be at the moment. I mean, hopefully we get the situation resolved sooner, otherwise there could be a real dampening in the markets.
Mm-hmm. What's interesting is you look at your share price now, it seems to have had its Iran moment, dipped, but it's back up to where it was. It seems to have performed very well through the Iran war.
Yeah, I think there's a big expectation that this conflict will end sooner than, it'll end soon, and hence that's been reflected in a lot of the market pricing. I mean, ICT, for instance, I mentioned a minute ago, the port terminal is trading at a 52-week high. It's a container port terminal, and we're just like, why is this? And I think there's expectation that actually the situation will resolve itself.
Is the market being slightly exuberant?
Possibly, yeah.
Jacqueline Brewers, Joint Portfolio Manager at Utilico Emerging Markets. Thank you so much for joining me on the Green Room Sofa today. The time has flown by. It has been a real pleasure. For those watching, thank you very much indeed for your time. Thank you. I'm here again with Sam Bell, CEO at Copia and Investor Summit co-founder. Sam is the more experienced private investor, and I'm learning the hard way. We're here to discuss the big investment news of the week in the hope that it helps you on your investment journey. And none of this is investment advice, of course. Greetings, Sam.
Afternoon.
So how are you today?
Very, very well. How are you?
I'm excellent. Did you have a good bank holiday weekend?
Oh, I did. It's a shame every weekend can't be 3 days, all right?
Well, I actually thought it was a bit of a pain because I was getting nicely into the week by Friday and I really thought I was smashing it. And I've completely forgotten what I was doing on Friday by Tuesday.
I suppose the other thing is you still have 5 days of work to get done, but in 4 days, right?
But in 4 days.
Yeah.
Yes, exactly. So anyway, we're doing well on the Investor Summit. Pete Higgins has been pulling the odd master stroke here and well, and we're making good progress with sponsorship.
Going very, very well. Looking forward to that. It's going to be a very good event if it keeps up this trajectory.
No, we're doing terrifically well. Yeah. So we've just been interviewing Jacqueline Brewers from UEM, Utilico Emerging Markets.
It's such an interesting concept of a trust. I think I was saying this to you yesterday. Emerging markets, ordinarily, you're in there for the growth, but this is also utilities, and for that, you're normally in there for the income. So it's quite an interesting concept of a trust.
And highly defensive.
Yeah, and they seem to be doing well. I think the share price up 30% over the past 12 months. So.
Share price up 30% on the year. NAV doing a lot better than it was. Around 11% down at the moment, whereas it was 16, 18%, which... having interviewed Charles Gillings, the the joint portfolio manager previously is frustrated, verging on furious at how disparate the performance has been relative to the NAV.
Yeah, you would be. And I suppose the thing you've got to watch with these NAV discounts is someone like Saba coming in and thinking they're doing you a favour, helping you close your discount.
Well, that does take us very nicely to a low light of the week, I would say, which is Edinburgh Worldwide being taken over by Saba.
Yeah. It's a shame, real shame to lose that one. And unfortunately, others in the firing line. One of the guys we work with that impacts environmental markets, they've done their tender offer, it's been taken up, and the rump of it likely to end up in Saba's hands as well there. So
the problem with Edinburgh Worldwide is that the shareholders fought back once, twice, and then effectively took the money out.
Yeah, only so far you can go when you've got a shareholder of 30% or more willing to go as far as it takes to.
And a second one in the sidelines as well. There were two of them, which took them to almost 60%.
It is
I think.
tough, very tough for some of these investment trusts at the moment.
It is indeed. But there's good news if it's talking points of the week time. The good news was there was a great win for Richard Stone at the AIC. He persuaded the government to include investment trusts in the Mansion House Accord.
I mean, mad that wasn't in there anyway, really.
Agreed.
So yeah, very good news to see that's across the line.
So that's 5% of a UK pension money into investment trusts.
Yeah, and there's some really good trusts out there. So, if we're looking for good news, you've got SSIT as well, Seraphim, doing their C class shares. Had a few people ask me how that actually works. I'm not sure it's, commonly understood, but essentially going to raise a whole load of new money. And while you're not initially investing in the ordinary shares and in their existing investments, as this new money gets used to make new investments, some of those C shares, as this happens, some of those C shares convert into ordinary shares, and then you become an investor in the main part of the fund.
The thing is about Seraphim, if you look at the NAV is way less than the share price.
I think it's 50% premium to NAV at the minute as we speak. So, but it's not stopping people. I mean, I've seen loads of people I know are looking at getting into it.
The C share is a way of saving people from themselves.
Yes,
I think.
Yeah,
simply because the NAV on the C share is much lower than it.
And it is being.
It's a cheaper share price.
It is being offered to retail as well, of course, so via retail book. So lots of people that I know, as I've said, quite interested to get in on that one. Again, as we speak, I think as we came on air, I've seen FTSE, which is another space-focused firm. Or certainly they've got SpaceX contracts, their share price popping as well. So it's a really hot area to be in at the moment.
Everything's driven by SpaceX, potentially the world's largest IPO ever.
Yeah, and all the media is touting that for June, I believe. So not far away at all. Could be happening in the next few weeks.
Hence so much excitement around Seraphim.
Yeah.
Yep. So we shall see. Now, is the Iran war on or off?
I mean, it depends who you talk to, right? So I think today Iran has literally struck American ships, but apparently that doesn't mean the ceasefire's off.
Trump said the ceasefire's holding.
Yeah. And I think this goes back to what we were discussing months ago, right? Who are they actually negotiating with now? You've got one single IRGC commander who feels like firing a few rockets or ballistic missiles, and he's not the guy that you're talking to. On the diplomatic side, they're probably walking quite a difficult line as to, when do they retaliate? When do they need to show some force? So if the Americans don't know, how do you know as an investor?
The markets seem to be shrugging it off pretty much. I mean, my portfolio is going sideways. My tech stocks are going gangbusters. But until the Strait of Hormuz is sorted out, my portfolio is not going to go into recovery mode.
Yeah, it's definitely one of those things where you say shrugging off, the market has just become tired, bored of the story. Certain things are going to still become a problem. Oil's still notching its way up.
Jet fuel or lack of it.
Plenty of firms cutting flights. That'll have an industrial knock-on effect sooner or later. I'd say any day now, really. Certainly measured in weeks rather than months. So a bit of pain to come, particularly here as well. I mean, we're going to have an interest rate issue at some point as well.
Yes, there's going to be economic pain in the UK and in a few other places. Interestingly, in America, they've had the highest diesel and petrol prices for years.
Yes.
So that's not going to do Trump any good in the midterms.
And this is a country that's pretty self-sufficient when it comes to fuel. So if it affects them...
But it all depends on the type of fuel. It's always about the type of fuel.
Yeah.
Anyway, on to more good news. We had an investor summit stand at the Master Investor Show, and I would like to shout out to the Master Investor people. They did really well.
Fantastic show again.
It was a fantastic show.
Thousands of people through the door.
But more than getting thousands of people, 'cause some of them have never invested in their lives and probably never will.
There's a big, retail investment campaign on at the moment. They're doing a public service. They're educating people that these opportunities are out there.
What was super impressive, from top to bottom, they had decent companies there. They had top quality fund managers and top quality people on the stands as well. It wasn't just...
it's really good names. I know Ed and Quoted Data guys are good at getting a lot of the investment trusts along there. What was nice from the investment trusts is that they actually sent their fund managers to talk to people in many cases. So you're not just talking to the IR people, you can actually, quiz the manager of the fund.
It was great. It was very impressive. I did enjoy it. It was hard work though. 5 hours of absolute graft. I didn't even have a drink, nothing to eat, nothing to drink for 5 hours.
Too many interesting people to talk to, right?
Well, even then, I never got round half the list I would have created for myself, and that's flat out for 5 hours. I didn't get round everybody.
So, what's the next one? It'll be Mellow in June, and then of course our own event in September.
Mellow in June. Yeah. I've not booked, but I shall. I've got it in the diary. Now we're back in we're ourselves on September the 18th. Are you looking forward to Investor Summit September the 18th?
Somewhat daunting, the amount of work to come between now and then, but still looking forward to it.
I'm foolish and naive because I'm so young. I'm still looking forward to it.
No, it'll be good.
Yes.
Always good fun.
Yes. And if there's anyone you would actually like to see represented at the Investor Summit, get in touch. That's what I would say.
We'll do our best to get them along.
And we'll do our best. We're doing our best to get Seraphim at the moment. We've got inside track. We know somebody who knows somebody at Seraphim, so we're trying to work our magic there.
Yeah.
You can only try. That's it for now, Sam. We're out of time once again. It was great to catch up with you. Thank you very much indeed for watching, and we shall see you next time. Do please take note, the views expressed in the Investor Summit Green Room podcast are for information purposes only, and nothing in this podcast constitutes a financial promotion, investment advice, or indeed personal recommendation. This Investor Summit Green Room podcast is produced by Copia, creators of investor events, video, and websites. If you've enjoyed our monthly podcast, please do subscribe on YouTube or follow us on your own podcast platform. And of course, we'd love to hear from you.